If you're watching this video, you're most probably a non-resident Indian living far away from your home country. You might have a great job, high salary, and a great lifestyle, but ultimately, most NRIs want to come back to India and spend their retirement life here. It doesn't sound that tough, but unfortunately, things go wrong for most NRIs just because they did not plan their finances properly. I talk to a lot of NRIs, and this is very true. Most people think that they got their retirement covered, but it's just that they haven't. It's all good as long as your money is working for you. But in a country where mis-selling is so rampant, every single person has to be their own financial planner. You should have the basic knowledge to separate the good from the bad, and in this video, this is exactly what we are going to address. How to plan your retirement, why a mutual fund portfolio will serve you way better than many other products in the market, and how to strategize your investments to get the best returns. Let's jump right in. Over the last few years, mutual funds have seen a lot of investor interest. In fact, the mutual funds market size in India has tripled in the last 5 years. Even though many NRIs are already investing in Indian mutual funds, many of them don't know how to structure it effectively according to their financial goals. The majority of us invest for a secure retirement, but unfortunately, most of us don't know how these investments can actually help us when we retire. So in the next few minutes, we are going to figure this out. This is the Home Advantage and welcome to another video. So we'll start the video by explaining what mutual funds are. We won't go in detail, and if you're already familiar with what a mutual fund is, feel free to skip this portion. We have all heard of the stock market, a place where thousands of companies are listed and we can buy and sell shares of these companies. A mutual fund is simply a collection of these shares. An XYZ mutual fund will have shares of multiple companies in its portfolio. So when we invest in this mutual fund, we're effectively buying the shares of all these companies. Except we don't have to study and pick these stocks. This job will be done by an experienced fund manager who is an expert hired by the mutual fund company to decide which stocks to buy and when to buy and sell these stocks. Alright, now you are an NRI who want to invest in mutual funds for your retirement. Now there are two ways in which you can make this investment. One, SIP or Systematic Investment Plan, and two, as a lump sum investment. SIP is when you invest a fixed amount every month. For example, your salary is 5 lakh rupees a month and you invest 50,000 rupees. You continue this until your retirement. Now, a lump sum is when you make a one-time investment. Suppose you suddenly get some extra money, maybe a bonus of 5 lakh at work. You can invest this 5 lakh as a one-time investment in mutual funds over and above your SIP. Be it SIP or lump sum, the idea is that the mutual fund units that we buy now will grow big enough to help us during our retirement. So back to the big question. How can we generate a monthly income from mutual funds when we retire? To do this, we have to follow SWP or Systematic Withdrawal Plan. Let me explain in detail with calculations. Suppose you're 35 and you start investing 50,000 rupees a month for the next 20 years. You also increase your investment amount by 5% every year. At 12% returns, you will have 6.37 crore rupees when you are 55. Now, we don't liquidate this entire investment right away. Instead, we start withdrawing a fixed amount every month. The most important thing to note here is that the amount that we don't withdraw stay invested in the mutual fund, and this is where the real magic happens. Suppose we withdraw 2 lakh rupees every month out of this 6.37 crores. So after the first month, the amount will become 6.35 crores, which continues to grow with the market. After the second month, we withdraw another 2 lakhs and so on. We do this for 20 years till you're 75. That is, we are withdrawing 2 lakhs per month for the next 20 years. So we withdraw a total of 4.8 crore rupees. Now what will be left after 20 years? The answer will shock you because we will have 43 crore rupees. But how was that even possible? We only had 6.37 crores to start with, right? Yes, we only had 6.37 crores, and yes, we have already withdrawn 4.8 crores. But the secret is that the remaining amount that we did not withdraw stayed in the market, and continued to compound at 12%. Now, this is the power of combining an SIP and an SWP. Now, there are a few things to note before setting up your SWP. In our example, we assumed withdrawing 2 lakh rupees every month for 20 years. Now, 2 lakh might sound like a good amount, but that's in today's value. Let's face it, inflation is very real in India. Our money is losing value faster than we imagine. At a 6% inflation, the value of this 2 lakh rupees will only be today's 62,000 rupees after 20 years. Now, this amount might be enough for some people, but might be nothing for others. It depends on a lot of factors like your lifestyle, family commitments, etc. So you will have to plan your investments according to your personal finance situations. Let me give you a walkthrough. Suppose you're 35 today and your monthly household income is 1 lakh rupees. This amount will keep on increasing 6% every year thanks to inflation. So after 20 years, you will need 3.2 lakh rupees every month to live the same standard that you're living right now. So now your goal is to plan your investments in such a way that you can withdraw 3.2 lakhs per month after 20 years with SWP. One thumb rule that we should follow while setting up your SWP in India is that we should only withdraw 3.5% of the entire amount every year. Why? Because if we withdraw more, the amount will deplete and won't be enough to last your retirement. Now back to our math. Our goal is to withdraw 3.2 lakh rupees every month. That's 38 lakh 40,000 rupees every year. Now for this to be 3.5%, our entire corpus should be close to 11 crore rupees. So now the goal is to make 11 crore rupees in 20 years. And there are two ways to do this. One is a normal SIP and two is a step-up SIP. As the name suggests, a step-up SIP is when you increase your SIP amount periodically. For instance, if you're doing a 10% step-up, your SIP amount will increase by 10% every year. Suppose you're investing 50,000 rupees every month and stepping it up by 10% every year. So in the second year, your SIP amount will increase by 10%, that is by 5,000 rupees. So your investment amount in the second year will be 55,000 rupees per month. And in the third year, this amount increases by another 10% and becomes 60,500 rupees per month and so on. The step-up frequency and the step-up percentage is completely under our control. We can plan it according to our financial situation. I hope the concept is clear. Now back to our goal. We have to make 11 crores in 20 years and two ways, SIP or step-up SIP. To achieve this goal with a normal SIP, you have to start investing 1,20,000 rupees per month for the next 20 years. But if you cannot set aside so much money today, you can always go for a step-up SIP. If you can step up your SIP by 5% every year, you should start with a monthly investment of 89,500 rupees. And if you can step it up by 10%, you only need to start with an SIP of 59,000 rupees every month. I know it's easy to plan a 10% step-up SIP theoretically, but you have to understand the practicality as well. If you're stepping up your investment by 10% yearly on a 59,000 rupees per month SIP, in the 20th year, you will be investing 5.69 lakh rupees every month. So make a plan according to your financial situation. The more you invest, the earlier you can retire. If you remember, we made this plan based on the assumption that our living expenses will remain the way it is right now. But the chances are it will only keep rising. So while setting your goal, always consider this and plan for a higher retirement corpus. And always keep in mind what Charlie Munger and Warren Buffett says. Frugality and saving aggressively is the most important step to getting rich. No, I'm not asking you to stop having fun, but instead be aware of your finances and your budget and always strike a balance between spending and saving. Also, we assumed a 12% returns on all our calculations. This may change based on our financial goals and risk appetite. Keep this in mind while making your financial plan. Now, how much tax should you pay in this scenario? In India, the long-term capital gains tax is 12.5%, which means we have to pay 12.5% tax on the profits that we make while selling our mutual fund units. Now, when you do a 2 lakh rupee SWP, you are essentially selling mutual fund units worth 2 lakh rupees on that particular day. So when you sell, the units that you bought first will be sold first. For example, you started investing at 35 and continue to invest till you're 55. Now at 55, when you sell the mutual fund units as part of your SWP, the units that you acquired at 35 will be sold first. Now you would have bought these units at X rupees per unit, and by the time you sell it, let's assume it became 10x. That extra 9x is your profit. So you have to pay long-term capital gains tax on this 9x. Now, after doing all the math, what if you realize that it's impossible for you to retire in 20 years? This might happen to some people, but that's okay. If you stretch out your retirement age by a few years, that can do wonders to your retirement corpus. And if you're in your 20s, make the most of the time in your hands and plan accordingly. Because everything from the funds you invested to the assets you should diversify into depends on your age. When you're young, you can take higher risk, but as you close in on your retirement, you should move the corpus to funds with lower risk. I hope the SWP planning part is clear. Before winding up the video, I want to discuss one more important topic, an investment that we all should try and avoid: fixed income insurance plans. I've seen a lot of NRIs invest in this fixed income, non-market linked insurance plans for their retirement. This will typically look like invest 10 lakhs a year for 7 years, then wait for 3 years and you will get a monthly income until you die. And the cherry on top, you get back the entire premiums that you have paid maybe at the end of 40 years. Sounds awesome, right? Well, it's not. Most of these plans look attractive only because we are not conditioned to factor in inflation. Once we add inflation to the mix, our returns is less than 6% in most cases. You will be shocked to hear that these insurance companies actually invest your money in the stock market, make massive returns, and give you next to nothing. In fact, LIC is one of the largest stock market investors in India. But unfortunately, they have lakhs of agents who call you every day to convince you to invest in these plans. All these insurance companies will go as far as lying to you to make you buy these policies. In fact, in financial year 2023, 58% of complaints before the insurance ombudsman was related to mis-selling. And it's understandable why NRIs fall for this. You trust the agent and you think that the agent is a person who can help you with all the documentations, which otherwise was a major hassle. But in this day and age, with platforms like Belong, everything is so easy. You just have to be aware of what you are investing into. Because if you rely on a bad insurance product to fund your retirement without considering inflation, your entire retirement planning could fall apart. Just imagine that situation. So if you're okay with slightly lower returns, go for a debt mutual fund. It's much more transparent than these insurance policies. So don't blindly trust that insurance agent. Research properly on your own. So in this video, we discussed in detail how to use mutual funds to fund your dream retirement. If you love what we're doing, subscribe and follow along. This is Aswin signing off until the next video.